There's a magic formula banks use to approve your loan, and if you don't know what it is, you're hurting your chances of getting approved. Mustika, everyone. I'm Georgina, a qualified loan specialist and co-founder of Estra Finance here in the Philippines. We create these videos to ensure Filipinos are equipped to make the most informed financial decisions, not turn their dreams into a reality. Today, we're diving into the world of home loans in the Philippines, specifically focusing on a term you absolutely need to know, your total debt ratio. Buckle up because I'm about to teach you something that can make or break your home loan application. Simulan na natin. Total debt ratio explained. So what is your total debt ratio? It's a financial metric used by the banks to assess your ability to manage monthly payments and repay loans. It's expressed as a percentage and calculated by taking your monthly debt payments and dividing them by your total monthly gross income. Basically, it's a mathematical equation that gives a quick snapshot of how much of your money is allocated to debts, like your car loans, your personal loans, and your credit cards, versus how much you have left over. The bank looks at this to decide how comfortable they are lending you more money. If the bank sees that you have a lot of money left over after paying all your debts, they'll think you're a pretty good applicant and will likely lend to you. On the flip side, if most of your money is already going towards debts, the bank might worry you're cutting it too close and could struggle to make new payments and therefore not want to lend to you. Why should you care about your total debt ratio? Before we get into the nitty-gritty details, let me explain why you should care about your total debt ratio. Firstly, when you apply for a home loan, banks want to know that you're a good loan applicant and that you'll be able to manage your monthly payments and eventually pay back all of what you owe. This is where the total debt ratio comes into play. It gives them a quick and straightforward way to assess that. If your TDR is over a certain percentage, they'll immediately know you're not in a good financial situation and can reject you straight away. Secondly, understanding your own total debt ratio can provide you with some valuable insights into your own financial health. Is it a good time to take on another monthly payment, or should you focus on cutting down on your existing debts or even increasing your income first? Lastly, your TDR can be a great indicator of how much in total a bank is willing to lend to you. I'll explain this a bit more later on. How is total debt ratio calculated? Okay, so now that you know what total debt ratio is and why you should care about it, let me explain to you how it's calculated. Here's the formula that the banks use in simple terms. The total debt ratio, or your TDR, is equal to your total current monthly debt repayments plus your monthly amortization of your new loan divided by your total monthly gross income times 100. And that gives you your total debt ratio. Let's look at an example of this. So if your monthly income is 50,000 pesos and your total debt, including your current debts and the new monthly amortization of the loan you'll be getting from the bank, equals 20,000 pesos, then your total debt ratio would be 40%. The lower your percentage, the better. In an ideal world, banks like to see total debt ratios of around 30 to 40%. What counts as income? Alright, now that we've discussed how to calculate your total debt, let's break down its individual components, starting with income. You'd think all money is good money when applying for a home loan, right? Well, the banks beg to differ. Not all income is measured equally. Whilst you might have several streams of income, the bank will not consider them all at 100% of their worth. I'm going to list some different incomes you might have, but please remember that every bank is slightly different and this may not be entirely accurate. These are general figures only. Okay, so if you're Filipino, employed locally on a full-time basis, the bank will generally consider the following incomes at these percentages. Regular wages or salaries, counted as 100%. Your regular wage or salary is counted at 100%. This is the most straightforward income. Part-time work, counted as 50%. If you've got a second job and have had it for more than 3 months, only 50% of the income you earn qualifies in the TDR equation. 13 months pay, counted as 100% so long as it's written into your contract. Performance bonuses. These are only counted at 50%. Since bonuses can fluctuate and aren't considered regular income, banks only count half of their value towards your income. Like bonuses, commission is only weighted at 50% because it's usually unpredictable income. Recent raises, counted as 100% if it's reflected in your most recent payslips. If you've just had a raise, you might think that this changes your base monthly income in the eyes of the bank, but this is not entirely true. The banks that calculate your income from more than one payslip, they'll average your income out over those few months. So if you need to provide 3 months of payslips but only got the raise last week, you'll only partially have that raise reflected in your borrowing capacity. You'll benefit from waiting until your raise is reflected on all of your submitted payslips in order to get 100% of it in your home loan. Overtime. Overtime is measured at 50%. Burning the midnight oil can pay off, but maybe not as much as you'd hope for when it comes to a home loan. Like commissions, overtime is considered variable income. Remittances. Counted at 100% if you're an OFW. If you're you're receiving money from someone overseas as your sole source of income, this doesn't count at all. You need to be the one earning the money via employment in your name for the income to count. Interest and dividend income. If you're a savvy investor and earn interest and dividend income, these are counted at 50% as well. Again, because these are considered less stable income sources. Rental properties. If you own a rental property, the bank will consider this as income, but how much weight it gets can be anywhere between 50 to 75%, and it does depend on the price you're renting it out for and whether there's a loan on it still as well. And that about covers most sources of income. Remember, these are general guidelines only, and not all banks calculate income the same way. I would love to get into the specifics for each bank, but unfortunately we'd be here all day. So your best bet is to check directly with your preferred bank for their specific rules. What counts as debt? Let's talk about the other side of the equation, debt. What kinds of debt are banks interested in when you're trying to get that home loan approved? Please remember that every bank is slightly different, but in general, most banks will look at auto loans, personal loans, installment loans, and micro loans. For example, if you got a new washing machine from a Benson's and chose to pay in monthly installments, that counts as a debt. And this also applies to Gcash loans if you've got them, or micro loans from any other type of lender. Banks are also looking out for government loans like a salary loan, lucky big loans, or SSS loans, credit cards, other home loans, business loans, and lastly, surprisingly, rent. Even though rent isn't technically a debt, some banks do include it in their calculations. If you're paying rent, that's less money you currently have to make mortgage repayments, so some banks do factor it in. Figuring out your monthly amortizations. Now, the last part of the equation is working out what your new monthly amortization will be. The word amortization simply means the amount you pay towards the loan. An amortization includes both principal, or the actual amount you borrowed, plus the interest, which is basically the fee you pay for borrowing that money. There are complex formulas for calculating this, but don't worry, you don't need to be a math whiz to figure it out. My top recommendation is just to use your preferred bank's online monthly amortization calculator. This tool takes into account current interest rates and loan terms to give you a reliable estimate of your monthly repayments. Banks' total debt ratio limits. Alright, now that you know all about incomes, debts, monthly amortizations, and now you have all you need to work out your total debt ratio, let's get into what the total debt ratio limits are for the banks. Generally speaking, banks like to see this number between 30 to 40%. If you're in this range, you'll qualify for a loan from most banks, but it's not the end of the world if you're slightly above this number. Every bank is flexible in their own way. In fact, whilst a lower ratio looks more appealing to banks, some banks are willing to consider higher debt ratios, and the two that come to mind are BDO and BPI. I've heard of them accepting clients with 50% or even 60% total debt ratios. But this isn't a guarantee for every applicant. It's measured on a case-by-case basis, and you'd have to be a pretty high earner to even be considered for these higher ratios. I'm talking about earning over 150,000 pesos a month, so that's obviously not achievable for everyone. So aim for the 30 to 40% total debt ratio. There you have it. Now you know how to calculate your total debt ratio, and you know what the bank's limits are. 6 ways to improve your total debt ratio. Increase your income. First things first, increase your income. Seems obvious, right? But it's easier said than done. Whether it's doing some overtime, asking for a raise, or even taking on a part-time job, every little bit helps your total debt ratio. Remember, the more you make, the less your debts weigh in the grand scheme of things. But keep in mind that even though you can inflate your income, it doesn't mean you should. Remember that the total debt ratio is there to help prevent putting borrowers into financial distress. Don't do the overtime or get a second job if you aren't 100% sure you can repay your minimum monthly amortizations without them. Yes, life is all about the grind and the hustle and the hashtag goals, but don't stretch yourself beyond your means, because you'll only end up potentially in financial ruin. Decrease your debts. Next, let's look at decreasing your debts. Eliminating or reducing even one debt can significantly improve your total debt ratio. So work on paying those debts off as soon as you are capable. The ones that are due first are more important than the larger ones, because overdue payments reflect badly on other things the banks look at when you apply for a loan, besides your total debt ratio. So keep that in mind when you start paying off your debts. Increase your down payment size. You can also increase your down payment amount. The larger your down payment on a house, the less you need to borrow from the bank, less debt you're incurring. Less debt you have, the higher your total debt ratio percentage. So save as much as you can as early as you can. Decrease your loan amount. If you can't save a bigger down payment, consider decreasing your loan amount. If you ask the bank to lend you less money, you're lowering your monthly amortization payments, which, you guessed it, improves your total debt ratio. Wait for better interest rates. Another way you can improve your total debt ratio is to wait for lower interest rates. Because the bank includes these in your monthly amortization, the lower the interest rate means the less you'll have to pay in your monthly amortizations. Interest rates are like the weather. They can be unpredictable, but they do have patterns. If you're not in a rush, consider waiting for a season of lower interest rates that can significantly help with your total debt ratio. Add a co-borrower. And last, but certainly not least, consider adding a co-borrower. By having a spouse or a family member join you in the loan application, you can pool your income. This might not only increase the amount you're eligible to borrow, but can also improve your total debt ratio. Now, there is something you have to keep in mind when it comes to a co-borrower, and that's their total debt ratio. If their debts outweigh their income, they'll bring you down with them as well, so choose wisely. So there are 6 actionable steps you can take right now to make your dream home a reality. Work on these and you'll be in a much better position when it comes to securing that home loan. And that brings me to the end of this video. I hope that cleared up a couple of things for you about total debt ratio, and as always, if you have any questions, leave them in the comments and I will get back to you. Total debt ratio can be a confusing topic for a lot of people, so there are no dumb questions. And as always, before I say goodbye and end the video, I would just like to mention 2 things. Firstly, if you're in the real estate industry and you've got clients who could use a loan specialist, we'd love to work with you to help your clients find the best financing for their situation. Estra Finance has a great referral program with uncapped commissions, so please sign up to our referral program using the link below. And number 2, if you're a potential home buyer and you're looking for some expert guidance from before you start buying your home to getting your loan approved to refinancing your home to get a second one, we're here to help. So just check out our website and jump on our waitlist. It's all linked down in the description for you. And that's a wrap on that. Please show your support with a like, comment, and subscribe to the channel. Ingat!